The Schwab U.S. Dividend Equity ETF, or SCHD, is a popular choice for investors seeking consistent income. It aims to track the performance of the Dow Jones U.S. Dividend 100 Index. This index is comprised of high-quality companies with a solid history of paying dividends. SCHD's appeal lies in its potential to generate passive income and grow wealth over time. SCHD's focus on dividends makes it particularly attractive to long-term investors. Dividends represent a portion of a company's profits distributed to shareholders. By investing in a basket of dividend-paying companies, SCHD investors can benefit from a steady stream of income. This income can be used to cover expenses, reinvested back into the market, or withdrawn to enjoy the fruits of one's labor. Furthermore, SCHD offers diversification across various sectors. This diversification helps to mitigate risk by spreading investments across different industries. If one sector underperforms, the potential losses can be offset by gains in other sectors. This balanced approach is crucial for long-term investment stability. Every year, SCHD undergoes a process known as Reconstitution. This process ensures that the ETF continues to hold the top 100 high-dividend-yielding U.S. stocks. During Reconstitution, the index provider evaluates companies based on several factors. These factors include free cash flow to total debt, return on equity, indicated annual dividend yield, and 5-year dividend growth rate. The reconstitution process involves adding and removing companies from the index based on their performance and adherence to the selection criteria. Companies that no longer meet the criteria or have slipped in their rankings may be removed. Conversely, companies that have consistently increased their dividends and demonstrated financial strength may be added to the index. This annual review and adjustment ensure that SCHD remains a relevant and reliable investment vehicle for dividend-focused investors. It also highlights the dynamic nature of the stock market, where companies constantly evolve and their financial performance fluctuates. The 2024 SCHD reconstitution saw a significant shift in its holdings, with approximately 24 to 25% of the portfolio undergoing changes. This significant turnover involved removing prominent dividend payers like Broadcom, Merck, and ADP. These companies were replaced by others with potentially slower dividend growth but stronger financial positions. This change has sparked debate among investors and analysts about the potential impact on SCHD's future performance. Some argue that the removal of faster-growing dividend companies could lead to a decline in the ETF's overall dividend growth rate. Others contend that the addition of financially robust companies will enhance the ETF's stability and long-term growth prospects. Only time will tell how these changes will ultimately affect SCHD's performance. However, it underscores the importance of understanding the ETF's underlying index methodology and the potential impact of reconstitution on its holdings and dividend payouts. Investors seeking potentially higher dividend growth may consider alternatives like the Vanguard Dividend Appreciation ETF, or VIG. VIG focuses on companies with a consistent track record of increasing dividends over time. This approach differs from SCHD, which prioritizes high current dividend yields. VIG's investment strategy has yielded impressive results, with the ETF consistently outperforming the S&P 500 index in terms of dividend growth. As of February 21, 2025, VIG's price stood at $201.98, reflecting a change of minus 1.07%, or minus $2.19 for the day. While past performance is not indicative of future results, VIG's history suggests that it could be a compelling option for dividend growth investors. Ultimately, the choice between SCHD and VIG depends on an individual investor's financial goals, risk tolerance, and time horizon. SCHD offers a high current yield and a focus on financially sound companies, while VIG prioritizes dividend growth and long-term capital appreciation.